Over the last week, Nvidia is down more than 2%, but when we zoom out just year to date, they are up a phenomenal 149%. In fact, when we take a look at the ratings, Wall Street still consider this a very strong buy. Now, in today's episode, we've managed to have a look at their latest 13F filing, which stipulates all of their recent buys, and in fact, they have been continuing to buy 4 different companies, which we are going to take a look in detail today. This is a company, in fact, Nvidia Corporation, that has a lot of cash on their balance sheet, 31.4 billion, and in fact, over the last few years and over the last 10 years, we can see their cash position is continuing to pile up. They have a lot of cash just sitting there that they do want to use to continue to help increase their top line revenue. And in fact, when we take a look at their latest investor presentation, not only their cash has been increasing over the last few years, but we also notice the same to be said with their free cash flows, their operating income, as well as their operating cash flow. So today's episode, we're going to take a look at each 4 of these stocks to understand whether or not we should also be buying before Nvidia buys every single share within these companies. Some of these have some incredible upsides as well, so you do not want to miss out. First one we are looking at is ARM Holdings PLC, ticker symbol ARM. Year to date up phenomenally 118%. It is currently trading towards the upper end of the 52-week range, and we also note even though Seeking Alpha does consider this a hold right now, Wall Street does indicate this as a buy for the portfolio. Now, a few things to note about this company. Their free cash flows over the longer term have been increasing. We do note that dip from 21 to 22. Since then, it has rebounded up and is expected to continue over the next 12 months, moving in that right direction that we do like to see. We also want to point out on the net debt to EBITDA over the last few years, it does sit at 0. What this indicates, the company has a very strong balance sheet. It wouldn't take ARM more than 1 day to pay off all of their debt net of cash on hand. Now we want to run them through the valuation model so we can get to our own intrinsic value as well as our acceptable buy price. And today we are using the DCF model. We do believe it to be the most relevant. Now we have the free cash flows over the last few years. We have the average growth around 53%. And in today's episode, we are focusing on a low, medium, and high growth grade. So you can also understand where the numbers are coming from and if you agree. So 25% with a discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by those shares outstanding, and we can clearly see here we get our first overvaluation signal. Now what this indicates, if you believe that this company over the longer term will increase its free cash flows by 25%, then ultimately right now the share price is showing implied downside of negative 44%. For those that believe that is way too conservative, at 30% we can still see we are getting an overvaluation signal, implying that this company has a negative 23% downside. Now again, people may say, look at their average just last year was 48%, you should go a lot higher. At 35%, we can clearly see our first signal of undervaluation. So if you believe over the next few years and beyond that it will increase at that 35% free cash flow level, there is around implied upside of 5%. Now, there have been lots of articles talking about the growth in this market, but we can clearly see that it is estimated just from this one article that from 2024 to 2030, the market as a whole will increase by just over 36% year on year. So again, this is a very subjective number. As always, you can grab a copy of this model if you do want to run your own numbers through by clicking on the pinned comment below. For example, if you believe that it should be even higher, as we can see at 40%, that would indicate undervaluation with an intrinsic value of $233. However, for today's episode, we will take through the medium growth rate of around 30% into our intrinsic value calculations. And what this essentially signals that in today's episode, we believe the intrinsic value to be $125. Therefore, we do see it trading at quite a premium. For those that wanted a margin of safety, now remember, on this channel, we use a 10% MOS level if it hits our 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. So if you believe that, then it is a buy at around that $113 mark. Always remember, though, that these numbers are being driven by the fact we have used that medium growth rate of 30%. In terms of Wall Street and their forecast, well, they believe over the next 12 months, there is upside, but only 3%. They have a price target of $168. We then move on to the next stock, SoundHound AI, ticker symbol SOUN, and we get another buy rating from Wall Street. Fairly strong, 4.28 out of 5, although we do note the other two analysts giving this a hold. It is trading right there towards its 52-week lows, and over the last year it is down around 16%. Now, a few things to note about this company: they are free cash flow negative, but we can see over the longer term it is moving in that right direction, and hopefully over the next year or two we can start to see this turn positive. The other thing that we want to note here is that their total sales has been growing at a very rapid rate just over the last 4 years in strong double digit. In fact, 22 and 23, 47% year on year, and on a trailing 12-month basis, we are seeing that 51% growth rate. So in terms of the valuation, let's jump in. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified as they drop. Now, we have the free cash flows year on year. We have started the 2024 position around management and analyst targets. So with that 20% growth, we do get an intrinsic value at around $4.20, which does indicate upside today of around 6%. Again, a lot of people will argue these numbers are very low, so a median rate of 25 does give a price of $5.50, and we can see that does indicate some nice upside of 39%. And for those that are fairly optimistic, a 30% growth rate would give upside of 83%. Now, as we said, we are taking the median one throughout just to be consistent, and that will give us upside of 39% in today's episode. And we can see the DCF valuation at $5.50 will give us some sense of margin of safety. So at that 10% level, we can see a buy up to $4.95. At 15%, we can see a buy up to $4.68, and at 20% around $4.40. So this does have some nice MOS level, but again, do bear in mind this is based on the fact of that medium rate that we have taken through. So at least a 25% margin of safety up to around $4.13. In terms of Wall Street and their expectations, well, as we said, a lot of bullish stocks in today's episode, they see this hitting $7.50 over the next 12 months with upside of 90% to the portfolio. Now, basically, with a price of $7.50, what we can see, Wall Street are indicating that the free cash flow growth will be more than 30% over the foreseeable future. So they are very bullish on this company. As always, though, let us know your thoughts about these as we go through. We then move on to the third one. We have Nano X Imaging, and we can see our first strong buy. In fact, Wall Street give this a 5 out of 5, a must buy for every portfolio. We have a buy from Quant with a hold from Seeking Alpha. Again, this is trading right there towards its 52-week lows, and in fact, over the last 12 months, it has been hammered down negative 52%. When we take a look at their free cash flows again, we can clearly see it has been negative over the last few years, something that we would want to see turn positive very soon in the near future. So moving on to NNOX's valuation, then let's get into that intrinsic value. And with the DCF model, starting off with that 20% rate, we do get an intrinsic value at around $10.47. Again, these will be subjective depending on what you do see with the market and the company in the foreseeable future. So 43% upside, that is very strong already just to start. 25% growth rate, well, we can see, in fact, that is nearly double the current trading price, hence why we see 87% upside. And for those who are feeling very bullish on this company, we can in fact see that would imply a very, very strong upside of 144%. So let's take through the 25% into the essential intrinsic value calculation. The DCF model giving us a price just under $14. And we can clearly see with the current price, we are talking about a larger margin of safety if you do believe those numbers. So 10% acceptable buy at $12.32. Then we keep going. We can go up in 10 percentage points given how much of a MOS we are looking at today. And we can in fact see that it isn't at that 50% level yet. It is pretty much on a 45% MOS based on the estimate and judgment that you do believe over the longer term it will grow essentially at a 25% rate. We then take a look at Wall Street, who are also very, very bullish, very similar to the previous stock. They see upside of 100%. They believe this is definitely one you need to consider in your portfolio. And as we can see, they do indicate this as a strong buy now. So definitely one to consider, and always let us know whether or not this is one that has been on your radar and one that you are looking to consider to purchase. Also, just to let you know, we've released our latest free weekly article literally minutes ago. If you want access to this, or any other articles, all completely free, do click on that pinned comment below. You can start to read straight away, instant free access. For example, if you want to see 10 undervalued stocks with excellent balance sheets, or you want to see some of the best dividend growth stocks to consider for the portfolio. We then move on to the final stock. It is Recursion Pharmaceuticals. This is pretty much flat over the last 12 months, trading again towards its 52-week lows with a triple hold from all analysts. And a few things we want to point out, again, very similar to the previous two, negative free cash flows, although it has started to decrease over the longer term, which is the right way that we do want to see for this company. And their balance sheet does look pretty strong. It has been coming down over the last few years. 0.45 over the next 12 months estimated is always a great sign to see. One of the things that we do like on this channel are companies with very strong balance sheets. So in terms of the valuation, then with a 20% starting off growth rate, we do get an intrinsic value showing overvaluation to begin with. So this gives us a sign of downside negative 23%. At 25%, again, we can pretty much see, you could argue, reasonable valuation. It does hit negative 1%. And when we finally move on to that very bullish 30% number, we do finally get to see undervaluation with this company, showing us 27% upside. As always, you can grab a copy, put your own numbers through to see whether or not you do agree with these numbers, or if it's another company that you want to test out. So at 25%, when we take it through to the final slide, that is giving a DCF price of just over $7. And when we look at margin of safety, in fact, in today's episode, we do believe this company is trading right there at its fair value. For those that did want to see a 10% margin of safety, well, you would need to wait for around $6.67, at 15% around $6.29, and at 20% just under $6. In terms of Wall Street and their estimations, well, they see this going up to around $15.67, upside 109%. Again, the last three companies, Wall Street do believe there to be a lot of upside, and if this is one, or in fact if all of them are one that Nvidia continue to buy up, then the share price could go up dramatically. As always, let us know your thoughts in the comments below. Maybe these are ones that were already on your radar, maybe they're now on your watch list, or for whatever reason, they aren't companies you are looking to add. Value was provided. Smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.